There is a $10 problem in the silver market right now, and it shouldn't exist. In a globally traded commodity, with instantaneous communication, with arbitrage desks, hedge funds, bullion banks, refiners, and sovereign players all watching the same screens, a $10 gap between two major pricing centers is not normal. It's not routine. It's not healthy. While Western spot silver has been trading around $86, China's largest silver recycler in Shenzhen was publicly offering $95 to $96 per ounce for 99.99% purity physical silver. Let's slow that down. Not a rumor on social media, not a speculative blog post, not an analyst raising a target, a real industrial operator with real balance sheets, with real inventory needs, posting a documented cash bid during the Lunar New Year holiday while the Shanghai exchange was closed. That detail matters because while Western futures markets were trading paper contracts, while algorithms were pushing price around, while liquidity was thin and headlines were hitting, in the physical world, in the largest precious metals consuming nation on earth, a recycler was willing to pay $10 more per ounce for real metal. That is not theory. That is not sentiment. That is a clearing price for tangible silver. And when you see physical metal commanding a double-digit premium over paper price, you're not looking at noise. You are looking at dislocation. Physical reality versus paper price. Now ask yourself a hard question. If you can sell real refined 99.99% purity silver in China for $95 or $96, while Western spot trades at $86. What exactly is $86 representing? Is it the price of silver, or is it the price of a futures contract that assumes silver is available somewhere in the system? Because there is a difference. Paper markets trade expectations. Physical markets trade scarcity, and right now the East is bidding actual metal higher, while the West is pricing derivatives lower. That's the fracture line. That's the tension. And divergences like that do not last forever. Either physical demand cools and premiums collapse, or paper prices rise to meet physical clearing levels. Historically, when there is a conflict between real-world supply and financial abstraction, physical reality wins, not because it's dramatic, but because it's enforceable. You can settle a paper contract in cash. You cannot fabricate an ounce of silver that doesn't exist. Shanghai reopens tonight, and that changes everything. This is why tonight is not just another session. Shanghai reopens. The largest physical silver exchange in the world comes back online after being closed for Lunar New Year. During that closure, Western markets moved. Silver sold off, recovered, chopped around, tested resistance, algorithms repositioned, funds adjusted exposure, but Shanghai was offline. Now it comes back, and it gets to decide what is silver worth in the largest physical demand center on Earth. That's the real question. Where does Shanghai open? Does it validate the 95-96 recycler bid? Does it open your Western spot? Or does it split the difference? Because if Shanghai opens at a meaningful premium, Western paper markets will not be able to ignore it. Arbitrage flows begin. Metal moves. Shorts reassess risk. Spreads tighten violently. And that reconciliation process? It is rarely smooth. It is rarely gradual. When price discovery shifts from paper dominance to physical urgency, the adjustment can be abrupt. This morning's structure, not random, not accidental. Before Shanghai even opens, we already saw positioning. Silver gapped higher at the open. It cannot drift sideways. It cannot grind slowly while shorts reload. It must clear the zone decisively. What does decisively mean? Wide candles, strong closes, volume expansion. No immediate rejection. Because if price lingers there, algorithms detect liquidity, short sellers rebuild exposure, momentum stalls. But if it punches through cleanly and does not look back, then 92 becomes mechanical. That's not optimism. That's order flow logic. This is not about belief. It's about execution. The volatility warning, stress, underneath the surface. Now add one more layer. CME's implied volatility index for silver has spiked sharply. Options markets are pricing large, unpredictable movement over the next 30 days. That is not a directional signal. It doesn't say up. It doesn't say down. It says instability. When volatility spikes like this, it means participants expect dislocation. Forced liquidation risk increases, margin pressure builds, thin liquidity environments become fragile, and in fragile environments, naked shorts become vulnerable, because if the physical bid strengthens while volatility is elevated, short positions can unwind at prices far above where they were initiated. And in that scenario, the market does not move politely, it moves abruptly. The core question. So we come back to the central issue. If physical silver in China clears at $95 to $96, while Western paper sits at $86, what does that Western spot price actually represent? Is it a true reflection of scarcity? Or is it a financial abstraction temporarily disconnected from physical flow? Shanghai's reopening may begin to answer that. Because when physical exchanges reopen after observing a week of Western paper trading, they don't react emotionally. They react economically. And if economics says silver is tighter than Western futures imply, then something has to give. And when it does, it will not be subtle. In part 2, we'll go deeper into the naked short pressure building on both exchanges, the evolution of price management tactics, Mexico's cartel instability and supply risk, the geopolitical premium embedded in gold, and the honest bear case risks that must be respected. But for now, understand this. A $10 physical premium in the largest demand center in the world is not noise. It's a signal. And when signals like that appear, they don't disappear quietly. So we have a $10 gap. We have Shanghai reopening. We have resistance sitting at 87 toners in 2-2 to 89. Now let S talk about what S really underneath this market. Because this isn't just about price levels. It's about structural stress. The naked short problem. In every futures market, there are short positions. That's normal. But in silver, there are documented naked shorts. Positions that are not backed by physical metal. That works fine in calm conditions, because most contracts are cash settled or rolled. But when physical demand surges, and when delivery risk increases, those naked positions become exposed. And here's the key. If forced liquidation begins, shorts don't get to choose the price. The market chooses it for them. That's what volatility spikes signal. Stress. Now consider this. There are reports that shorts are also caught on the Shanghai side. That creates cross-exchange pressure. If both Eastern and Western shorts are stressed simultaneously, liquidity thins, spreads widen, moves accelerate. That's when gaps happen. The pattern shift. Here's something subtle but important. Large, obvious price slams in silver futures have become less frequent over the past week. Instead, activity has shifted into the options market. Less visible, harder to track. But CME volatility data confirms stress is building underneath. This suggests price management, and if it exists, has adapted. But volatility cannot be suppressed forever. When pressure builds long enough, it resolves. And resolution is rarely gentle. Mexico, the supply wild card. Now let's talk supply. On February 22nd, a major cartel leader in Mexico was killed in a military operation. Historically, removing leadership does not stabilize regions. It fragments them. Factions compete. Violence increases. Instability spreads. Why does that matter? Because Mexico produces roughly 1 in every 4 ounces of silver mined globally. 25% of global supply. If instability spreads into mining regions, even minor disruptions tighten an already fragile system. Now, to be clear, there is no confirmed production drop yet. This is a risk signal, not a confirmed shortage. But when supply is already tight, you monitor risks like this carefully. The geopolitical layer. Zoom out further. U.S. military assets remain positioned in the Middle East at levels not seen since 2003. Carrier groups, cargo aircraft, forward positioning. The Iran situation is paused, not resolved. That embeds a structural risk premium into gold pricing, and that premium does not disappear until the underlying risk disappears. Look at the divergence. Gold rising toward 5,150, silver up over 2%, equity futures red. That's capital moving toward safety. Institutional capital. The honest bear case. Now let's ground this. Volatility cuts both ways. The CME spike means large moves can happen down as easily as up. Coordinated intervention by major banks, which have a documented history in metals markets, is always possible. A liquidity event in another asset class could force broad commodity selling. Shanghai could open more measured than the recycler data suggests. And Mexico's instability has not yet translated into verified production disruption. These are real risks. They must be respected. The fundamental question. But here's the question that matters most. If physical silver in China clears at $95, while Western spot sits at 86, what does 86 represent? Is it the price of silver? Or is it the price of a leveraged paper instrument that assumes delivery is optional? Because when the physical market and the paper market diverge by $10, that's not noise. That's a structural signal. What happens? Next, Shanghai's reopening is the catalyst. If it validates the recycler price, if it opens strong, if premiums expand, Western paper must adjust upward. If it opens flat or cautious, the tension builds. Either way, the gap will close. Gaps of this magnitude do not persist indefinitely in globally traded commodities. They resolve through price. Final verdict. The most important signal in silver right now is not a moving average. It's not a headline. It's not a tweet. It's the $10 gap between physical East and paper West. A real recycler offered $95 to $96 for real metal. Shanghai reopens tonight. Resistance sits at 87.20 to 89. Volatility is elevated. Shorts are exposed. Mexico carries supply risk. Geopolitics embeds premium. The data is public. The structure is visible. Now we watch. Because when physical reality forces paper to reconcile, the move is rarely subtle. Stay alert. Compare Shanghai's open to Western spot. Track the volatility index. Monitor Mexico. And remember, the market always reveals the truth. The only question is how violently.